Now, quick recap. Many of you I met at the VRIC in Vancouver over the weekend, which was awesome to see a lot of members, a lot of new followers and faces. Overall, I was chatting and talking with a lot of different experts. Robert Kiyosaki and Jay Martin put it on. Amazing event. Overall, I was there talking about the different way to invest, which is our ACS strategy, our asset revesting strategy. And I kind of wanted to show a few things because we have a lot of new members and a lot of people wondering how we perform, where our real value is for the service. So I kind of want to just really touch on this micro kind of little baby presentation real quick here. More or less, I believe there are some high risk, low return strategies, which is the buy and hold. I'm going to show you some comparison charts because that's what I think connects best with everybody, and why falling in love with stocks is so dangerous. And then, of course, holding dividend stocks. Most of you have picked up on that recently because it's important to understand how dangerous it can be. So let me just quickly show a couple charts here. I think the really important thing to understand is the buy and hold strategy. The top here is our longer term TTI investing strategy. We have a bull cycle start, a bull market trigger started just after COVID, rallied 41%. Then we went into a small bearish phase where we move out of the markets. And then, of course, we've had this new bull signal, which we're riding up now, up about 44%. And if you were to invest $800,000 back after COVID, you'd have $141,000. Then you reinvested at a lower price. Now you've more than doubled your money with two positions during this bull market, these bull market phases. Now, if you go to the typical 60-40 buy and hold portfolio, over the same time, you'd have a much smaller return, and you ride this roller coaster of having huge returns, going negative, giving it all back, and then going back up and having mediocre. So the buy and hold is going to guarantee that roller coaster ride. And this is what I know a lot of you still have. And the volatility, this even on a shorter term basis, what we've avoided with the NASDAQ and the SP 500 over the past month of sitting in a very low volatility position is we're not riding that stock market wave up 3.5%, down 3.5%, all of that, and having this big volatility. And so the roller coaster ride of the buy and hold puts a lot of strain on individuals. Now, if we take a look at the diversification side, this is where we really stand out and add a lot of value. So we were long the bond market, which is TLT, this bottom chart. And this was back in our last trigger. And if we take a look, we got out of the bond market. We moved into stocks because the strategy, the markets was saying, hey, get into the equities market. We hit our first target at 3%, second target at 10%. The trend changed about a month ago, and we closed the rest out at a 6.5%. Now, if somebody who has stocks in bonds, if you still held bonds, you were down 12.5%. And this is where we really stand out, is knowing which asset class to move into and when to step aside into something boring like the dollar or just a cash position. If you take a look at this middle chart here, this is the 60-40 portfolio. Over the same time, you are down 3.5% simply because your winners are crushed and all the gains are taken away by your losers. Diversification means you're going to have winners and you're going to have losers, and then you get this really low average return. And so this is what we're allowed to avoid, is having this diversification and this underperformance of a strategy. The other is falling in love with a stock. Could be silver miners, could be gold miners, could be uranium, could be marijuana stocks, whatever they are. They go through these cycles. As we all know, there's 4 stages. Each stage requires a different strategy, which most people trade the same strategy through all market conditions, and they wonder why they struggle. But when you have multiple strategies, or when you hold stocks that you love, you have this thin blue line roller coaster ride. Huge returns, you feel like a superhero. Then you give it all back and you're all over the place, versus something like what we do, which is super slow, really boring, and it's like watching paint dry, and we're just slowly rotating, compounding our growth on small trades, 1-2 base hits, time after time, just slowly adding this growth and the stability. That is what we focus on. So the other aspect here, the other area that a lot of people don't realize, is the dividend space, which recently we've seen the SP 500 pull back about 4.5%. If you hold dividend stocks, you're down almost 10% or 9.5%, showing the volatility that dividend stocks have. During COVID, the stock market fell 35%, while the dividend stock market fell almost 50%. And this is why retirees get hit so hard. They all hold the same stocks, the big blue chips, the big dividends. And when they all spook, they all sell the same stocks at the same time, and they drive those super strong, solid dividend paying stocks to the downside and really hurt each other because they're all panicking at the same time. So when you look at a comparison of something where we just rotate into little trade after little trade, compounding our growth on top of each other, something that's always up, generally up and to the right, the dividend strategy, which is this thin blue line, you have more downside risk, and dividend stocks don't really rally huge. So you have very limited upside. So you got twice the downside risk and really not a whole lot of upside. And that's the dangers of dividend stocks. Last but not least, I know some of you wanted to look at the comparison of how we compare to the NASDAQ. Obviously, this top blue line is our ACS strategy. This gray line is the NASDAQ from the 2008 market top. You can see here we have we're matching its performance more or less. And if you just compare it, this is what some people for some reason don't pick up on or understand maximum drawdowns. The difference is the NASDAQ is up 800+%. So is our strategy. And we do it in a very low volatility way, which you can see right here. The max loss, the max volatility that the account had to go through for the NASDAQ was 50%. And we are less than 6% since the 2008 market top. That is going through multiple bear markets already. It's going through the flash crash in May. That is going through the 2022 bear market. It's going through COVID crash. So it shows the stability, the protection that we have. And this is the real value, is being able to get into things and know we're not going to lose our shirts. It doesn't matter what happens in the economy, what news or the Fed does, all of that stuff. So that's kind of where the real value comes. And we are right now in this stage 3 topping phase. It's completely camouflaged. I still believe we're stuck in this stage 3 phase, very sector driven, meaning a sector's in favor for a little bit, then it falls out. And there's certain strategies that do really well. The TTI, which is that longer term investing chart I showed you, it is going to come out of favor here soon and eventually put in a major top and exit. But when we look at a stage 3, these strategies that will pull through all markets, allow us to take advantage, is the consistent growth strategy, also known as the ACS strategy, the adaptive compounding strategy, and OTS, which is our options service. We write and sell options. We can pull money out of the market with low volatility, high volatility, all of that stuff going forward. So anyways, that's kind of a micro presentation. I know a lot of you are wondering where the value is, and I'm trying to show the difference of a really volatile account versus underperforming with dividends, and how falling in love with stocks and all that stuff creates a lot of noise and a lot of risk to your account versus what we're doing when the markets move into a sideways phase with no clear direction. We move into a very slow moving asset and don't have to worry about these big pops and drops and live through those roller coaster rides. Anyways, that's it for now. Take care. Bye-bye.